Good afternoon. Welcome to Midcap Radar. I'm Sonal Putra. With me, as always, is Vivek Iyer. Well, what a day, right? Today, we are seeing a second consecutive day of fall, and especially in the mid-cap side of things, 1,000-point cut yet again. The advance decline ratio absolutely in favor of the advances. On the NSE, it's 1:10. So that's the kind of cut that we are seeing right now. All the sectoral indices, they are reeling with cuts right now. Nifty is below that 24,600 mark. Does not look so good, at least for the broader markets.
Well, the screen doesn't look good at all. And like you mentioned, 1:10 is the kind of advance decline ratio that we're actually dealing with. So it's a very negative market. On the top of your screen, you can see how all of the indices are bleeding. And if you add the small cap index there, that too is down by over 3% in an intraday session. But quite a lot lined up on the show. Let's start off with the top headlines. Stocks continue to trade with a downward bias, with declines far outpacing advances. All sectoral indices slip into the red, while the pain worsens in the broader market.
Hyundai Motor India makes history by debuting on Indian stock exchanges after the country's biggest IPO. But the stock list is a discount to the offer price as analysts remain divided on its growth prospects. The global CEO is confident of growth and sees more capital investments in India.
Private sector lender City Union Bank surges over 13% after reporting its Q2 numbers. Asset quality improves while net interest margins widen sequentially. Management tells CNBC-TV18 that secured MSME, gold and agri will contribute to loan growth going forward.
Adani Group's Ambuja Cement is set to acquire 46.8% in Orient Cement from promoters and other stakeholders at an equity valuation of 8,100 crore rupees. The deal triggers an open offer to the shareholders of Orient Cement and sparks speculation over more M&A in the sector.
Amber Enterprises slips over 12% ahead of its results. Stocks cools off after rallying 20% on Monday. Street expects revenue and EBITDA to surge over 30% in Q2.
All right, so we have spoken about how the markets are doing right now, but as we've been talking about the big mid-cap space in the fall that we've seen there, so let's go across to Hormaz now. He's taking us through the fall in mid-caps from the high made on September 24th this year. Hormaz, is that a long list?
It is a long list indeed, but a 7% fall from the record high would not be concerning in a usual market. But for those who are used to waking up and seeing broader markets make new highs every single day, a fall like this would definitely set alarm bells ringing. And for the mid-cap index now, it's down 7% from the peak that it made on the 24th of September. And since then, only 20 mid-cap index constituents have delivered positive returns and 80 of them have delivered negative returns. And if you break those 80 down as well, the losses are not anywhere between 2 to 5%. Look at this, 11 stocks have loss of more than 15%, 24 of them between 10 to 15%, and 29 of them have seen losses of between 5 to 10%. Shows you the kind of fall that you had. Now let's look at the top losers since the 24th of September, and you'll have the usual suspects, the high beta names, Vodafone Idea, Cochin Shipyard, Suzlon. As fast as they've gone up, they have corrected equally fast as well. Bank of Maharashtra forms in this list as well, but the list doesn't end here. There are another set of underperformers like L&T Finance, MRPL, HUDCO. All of them have corrected anywhere between 15 to 20%. But if you look at the broader picture and take these underperformers from their own respective highs, the picture is even grimmer. Look at Vodafone Idea, down 56% from the peak that it made of around 19 rupees. Cochin Shipyard made a record high in the month of July. It has already halved in the next 3 months. MRPL, HUDCO also made a high very recently. It's down 44%. RVNL, the high-flying PSU2, is down 32% from its record high. Does not look good right now for the mid-cap index. It's down only 7%, but on a stock-specific level, the picture is even more worse.
Okay, all right, Hormaz, thank you so much for getting us that list. So big cuts that we are seeing in the mid-cap space. But for now, we'll take a short break. Management of Supreme Industries will join us next to discuss the Q2 numbers and the way forward. Stay tuned for that.
Welcome back. Well, as promised, Supreme Industries, which just reported its Q2 earnings. Remember, the company's net profit has declined 15% on a year-on-year basis, while its revenue too has declined. MP Taparia, the Managing Director of Supreme Industries, joins us now. Good afternoon, Mr. Taparia. Thank you so much for joining us. Anyway, we are looking at it. Q2 appears to have been quite a subdued quarter, and also there appears to be a guidance cut that you've taken as far as the full year volumes are concerned. Please take us through, what were the challenges you faced in the quarter gone by?
Challenges to our mind, they are all now behind. In the second quarter, the prices went up in the beginning of the month in PVC. Actually, our main raw material prices went up by 19%, and then by mid-August, it went down by 17%. That happened due to the Red Sea shipping blockage. There was very poor productivity of container movement, and the country depends on 66% on imported PVC, and out of 66%, 80% comes from Asian countries. The freight went up by even $160 per ton. So the local maker and everybody, the prices went up so cheaply for a short time, and then when the freight rate started coming down, the rates have gone down by 17.5%, I told. Secondly, government also reduced their infrastructure spending in first half of this year. Monsoon also was extended in the month of September, and that cumulative effect was that we had 0% volume growth, and because there was huge destocking throughout the value chain of plastic piping system. Now that huge destocking which took place, now they required restocking again. Now things are stable. The infrastructure spending also improved. The pricing of the raw material are at a low level, and we maintain they may either remain the same level or may slightly go up. So we anticipate good business coming in the remaining second half of this year. So overall, that's why we are required to reduce our guidance, which we gave earlier, 25%, that this year we may grow between 16 to 18% in plastic piping division and 14 to 15% overall company.
Okay. 14 to 15% overall growth is what you're expecting for the company, and in the plastic piping business, it'll be around 16 to 18%. That's the revised volume growth. Mr. Taparia, you spoke about how freight rates impacted the business in first half. While other things have improved, maybe the infra spending by the government has improved, monsoons normalized. Are you seeing improvement in freight rates as well? Because that continues to be an issue. How much of your export, how much does export contribute to revenues?
Our export is very minimal. We export below 3% of our turnover.
Okay, so is it the imports which is being impacted because of freight rates?
Import was affected because country on PVC raw material, country depend on country depend on 66% import. Because country consumes 4.5 million ton, 1.4 million ton local production, 3.1 million ton imported. And out of that import, more than 80% come from Asian countries. And Asian countries, the container produce was so low, the freight has gone up from $30 to $200 per ton.
Okay. Mr. Taparia, two-part question. Q1, volume growth of 17%. Q2, volume growth has stayed flat. Now, even with the revised guidance, Q3 and Q4 actually are asking for quite an implied steep ask rate as far as, year-on-year growth is concerned. So will you be able to meet that? Are you seeing enough demand on ground? And the second question is, earlier you had given an EBITDA margin guidance in the range of 15 to 15.5%. With rising input costs, will you be able to meet that particular margin guidance?
No, first I talked to you about the volume growth potential. Normally, second half, every year grows much better than first half. First half, the month of July, August, September, demand remained weak due to monsoon. Second half, after crops are harvested and the business season is fully in swing, so business always remains better than compared to first half. This year, the added factor will be that a huge destocking took place, which will give bigger boost in the second half compared to first half. So we are very confident that whatever volume growth we have planned, we will achieve without any trouble. we have got capacity in place, and the raw material position also we are very well covered, so there is no issue. On the operating margin, we aim that we will earn this year also between 14.5% to 15.25%.
Okay.
And overall trade also
14.5%. Yes, sir, go ahead.
to 15.25%.
Okay. 14.5 to 15.5% is the margin guidance that you have for FY25. Mr. Tapadia, last question before we let you go. What is the kind of capex that you have planned? Now, it's not only plastic piping business, you have forayed into different segments as well. Is the peak capex over? Will you be putting in more in terms of capex? And what are the plans of funding it as well?
We had a plan to have a commitment, including carry forward commitment of 1,500 crore this year. Our capex plan is going very smoothly. In the current year, we are going to make cash payment of around 1,000 crore. In first half, we already paid 427 crore, and the capex plan is all going to be met by our internal accrual. No debt. We got our own money in our account, and we'll be taking care of all capex plan from our own resources.
Mr. Tapadia, thank you so much for joining us. So quickly after declaring the results, we wish you all the best for a much better second half of the year. Moving on, a small programming note as we slip into a break. As we prepare to ring in the festivities this Diwali, tune into CNBC-TV18 at 3 p.m. on the 29th of October to hear out the biggest of market voices giving their tips on how you can make your portfolio prosper this Diwali.
Welcome back. While it's a lot about the moves on the benchmarks and the headline index, it's a lot about individual stock reactions as well to earnings. So let's get to that. Our research team is joining in to give you a sense of what the results reactions have been like. Abhishek and Mangalam are joining us now. Let's start with Mangalam first up on Manmohan Beverages. It is trading in the green in an otherwise weak market. How do the numbers look, Mangalam?
Well, the numbers, despite the challenges that were there in the quarter, the numbers don't look very bad. It's a good performance that has come in from Manmohan Beverages. Why do I say that? Because if you look at it, 24% revenue growth is what the company has reported this time around, 4,800 crores on the top line. The EBITDA has grown by 30%. That means the margins have expanded from 22.8% to 24% as well. And the net profit too, as a result of which has shown a growth of 23%. The key internals, the overall volume growth this time around has been close to around 22% or 267 million cases. But that has also been led by acquisition. So the important number to look at would be organic volumes. International volumes have grown at 7.9%, India volumes at 5.7%. One would say, why is it that the India volumes have moderated? Because remember, this time around, there were heavy rains throughout the quarter. We've heard from, players like Tata Consumer and Dabur also speak about the beverages business not doing particularly well. And in light of that, if a company has grown volumes by 5.7%, it is a positive. What are the key triggers for Manmohan Beverages going forward? Commissioning of their greenfield plant in Congo, 7,500 crore fundraise via QIP, where they deploy that in terms of growth, an increasing share of revenues coming in from snacks, which is non-beverages business outside of India, and energy drink, which is Sting, which has been the growth driver for the company going forward as well. The only risk, the big risk is competition from Campa, which has been launched at a very disruptive price. We also have competition in the energy drink space. Earlier it was just Sting, and now everyone has launched their 5-10 rupee energy drink packs as well. And finally, increasing consumer preferences towards healthy lifestyle. So reducing sugar or sugary drinks is something we will look at as a macro underlying trend. But given the challenges during this quarter, Manmohan Beverages has actually gone ahead and done a lot better than what the street was fearing.
Thank you so much for that, Mangalam. No wonder then the stock actually is outperforming in an otherwise weak market. Well, moving on, Jana Small Finance Bank is slipping in trade after reporting its Q2 numbers. Abhishek is here with more details.
Well, stress in the unsecured segment or the rural segment has actually continued to weigh on Jana Small Finance Bank's results. So over the last 2 quarters, that is after Q4 FY24 to about Q2 FY25, if you take a look in absolute value, gross NPA has increased more than 50% for them, and net NPA has increased more than 90% for them. So gross NPA has increased to 755 crore from 494 crore at the end of Q4 FY25, while net NPA has increased to 247 crore versus 130 crore that it was there at the end of Q4 FY24. So in terms of Q4 FY24 to Q2 FY25, deposits have grown a little under 10%, while AUM growth has been just 6.7% in the same period. So in Q2 FY25, their AUM growth was about 17.3% YOY and about 2.7% sequentially. Their net interest margin declined by 30 basis points on a sequential basis, while gross NPA in absolute value increased by almost 17% quarter on quarter. In terms of ratio, gross NPA ratio is now close to 3% versus 2.6% in the previous quarter. And return ratios, if you take a look, that is ROA and ROE, are perhaps the weakest that you are seeing for a lender or small finance bank in Q2 FY25. So ROA is at 1.2% versus 2% in the previous quarter, and ROE is at 10.2% versus 17.6% in the previous quarter. So deterioration in asset quality and weakening of the return ratios has weighed on the stock performance in trade today.
Okay, that is about Jana SFB, a big cut that we are seeing on the stock. The other stock which is declining in trade ahead of its results, that's Amber Enterprises. But do remember, the stock was up 20% yesterday. Upasana is joining us with what to expect from the numbers today. Upasana.
Well, we're expecting a good set of numbers from Amber Enterprises. This time around, we're estimating revenue around 1,200 crores with a 30% growth uptick on a one-year basis, mainly driven by companies' consumer durables and electronics segment. We're estimating EBITDA around 84 crores with an uptick of 41% on a one-year basis, and EBITDA margins around 7% with an uptick of 60 basis points on a year-on-year basis. Now, margin improvement will be driven by mix shift towards components in consumer durable segment, and we are expecting PAT positive around 1 crore versus loss of 6.9 crore on a one-year basis. Now, there are various factors that we'll be closely watching out in the management commentary, such as demand outlook for RACs, outlook on electronic segment growth, margin improvement across the segments, revival in companies' railway segment, and also any commentary on update on export opportunities by the company.
Thanks so much for that, Upasana. It's been a volatile couple of trading sessions as far as Amber is concerned. An upper circuit yesterday and today down almost 10%. Well, moving on, my colleague Prashant Nair spoke to Manish Chokani, the director at Inam Holdings, to get his views on the big FII selling, consumer slowdown, and a lot more. Let's listen in to excerpts from that conversation.
A bit like 2008, except the base is very different. Much larger. We're 3.5 times of that time. And also the fact that there's a lot of domestic money, otherwise this would have been a deeper correction. Yeah. But having said that, foreigners own 15-16% of India. So it's about $800 billion at least of stock which they have. So they've sold 10 billion. It's like poor chaps have traded 1% of what they hold. We shouldn't be grudging them that. In the context, in the last 6 months alone, we've raised $30 billion in our markets, of which 15 has come from companies raising it for building new capacities or whatever. Right. But 15 has actually been promoter and private equity selling. So if this sort of selling can get absorbed, it creates confidence that this is actually a two-way street. I'm not trapped like I'm in China or in Africa. The expansionist tendencies in businesses are going to come out of Asia now, largely, or maybe the Middle East. So the Middle East money, I think, is still coming with the sovereign funds and so on. But unfortunately, the Asians, and especially the Japanese, have still not come in big force. Portfolio flows from the West, FDI from Asia and Middle East. I think there will be significant money coming from there.
Well, very interesting comments coming there from Manish Chokani. As we take your leave on this edition of Midcap Radar, what we are leaving you with is a very red screen. The mid-cap and the small-cap end of the markets continue to take it on the chin and witnessing intense selling pressure with very weak and muted advanced decline ratio.